Hello everyone, my name is M.Rizki Kurniawan, with student ID number 224111035. In today's presentation, we will discuss financing institutions in business activities, a topic that is crucial for entrepreneurs, business managers, and anyone interested in understanding how businesses get the funding and financial support they need to operate and grow. Financing institutions are not just about lending money. They provide the financial backbone for companies, enabling them to acquire assets, manage cash flow, and expand their operations. According to Presidential Decree number 61 of 1988, a financing institution is a business entity that provides funds or capital goods without directly collecting funds from the public. In simpler terms, these are specialized organizations that supply financing in various forms, such as leasing, factoring, venture capital, consumer financing, and credit card services to support businesses and consumers. Let us go through the 5 main types. A. Leasing. Leasing is a financing method where a company, the lessor, provides capital goods for use by another company, the lessee, for a specific period, based on periodic payments. There are 2 main types: finance lease, with an option for the lessee to purchase the asset at the end of the lease period. Operating lease, without an option to purchase, focusing on service provision. Parties involved in leasing include lessor, the owner of the asset who leases it out; lessee, the user of the asset who may have an option to buy; supplier, the seller of the asset being leased; insurance company, covers risks related to the leased asset. Key characteristics of leasing: the asset remains owned by the lessor. The leased asset is necessary for running the business, such as machinery, vehicles, or equipment. It is a form of financing, not just renting. Example: a manufacturing company leases industrial machinery instead of buying it outright, saving upfront costs and preserving cash flow. B. Factoring. Factoring is when a company sells its receivables, outstanding invoices, to a factoring company at a discount in exchange for immediate cash. Services provided by factoring companies: financing services, providing funds against invoices; non-financing services, managing credit administration, assessing creditworthiness, and monitoring payments. Benefits: for the creditor, reduces the risk of loss from unpaid invoices; for the debtor, encourages faster payment; for the factoring company, generates revenue from fees and interest. Example: a clothing manufacturer sells its unpaid invoices to a factoring company to get instant cash to buy raw materials for the next production cycle. C. Venture capital. Venture capital is equity investment provided to startups or growing companies in exchange for ownership shares. Unlike traditional loans, venture capitalists not only provide funding but also assist in management, networking, and strategic decision-making. Characteristics: temporary investment, usually 5-10 years, no collateral required, profit-oriented, the venture capitalist expects a return on investment. Advantages for companies: access to capital without needing to meet bank loan requirements, strategic guidance from experienced investors. Disadvantages: founders may lose some control over decision-making, ownership dilution as shares are given to investors. Example: a tech startup receives venture capital funding to develop and launch a new mobile application. D. Consumer financing. This is financing provided to individuals for purchasing consumer goods through installment payments. It helps consumers buy goods like furniture, electronics, and household appliances without paying the full price up front. Example: a customer buys a refrigerator through a consumer financing company, paying in monthly installments over a year. E-credit cards. Credit card financing allows consumers to purchase goods and services using a line of credit provided by a bank or financial institution. This type of financing is widely used because it provides convenience, flexibility, and a cashless transaction method. However, credit cards are only granted to customers who meet certain requirements, ensuring they are reliable and able to pay back the borrowed amount. Financing institutions are the bridge between business ideas and business realities. They provide the resources that allow companies to acquire assets without large upfront costs, maintain healthy cash flow by turning receivables into immediate cash, access expert advice and strategic partnerships through venture capital, enable consumer purchases, driving sales and market growth. Without financing institutions, many businesses, especially small and medium-sized enterprises, would struggle to survive or expand. Imagine a small manufacturing company that wants to upgrade its production machinery. It could lease the equipment instead of buying it outright. If it needs quick cash to pay suppliers, it could sell its receivables through factoring. If it has an innovative product idea, it could seek venture capital funding. It could also boost sales by offering customers consumer financing or accepting credit card payments. These options show how financing institutions create opportunities for growth at every stage of business. In conclusion, financing institutions in business activities are essential components of the economic system. They enable businesses to secure the funding, assets, and financial tools they need to operate efficiently and grow competitively. From leasing to credit cards, each financing method plays a unique role in meeting different needs, whether it's funding expansion, improving cash flow, or helping customers purchase products. Thank you for your attention. I'm M.Rizki Kurniawan, student ID 224111035, and that concludes my presentation for today.